Hi, this is Mike Rosendahl with PCE Investment Bankers, and today I'm here with my colleague Will Stewart, and we're going to be discussing how to achieve growth through acquisitions in this challenging environment. Before we get started, I just want to introduce my colleague Will Stewart. Will?
Morning, Mike. Thanks for having me. A pleasure to be here to talk to you about this. Look forward to talking to companies about how to make acquisitions generally, and more specifically, how to take advantage of some situations brought on by this current disruption we're experiencing.
Yeah, it is an interesting time, and I think companies that spend some time thinking about a strategy can really position themselves for growth not only through this crisis, but really accelerate their growth post-crisis. So with that being said, let's get started. What is the state of the market? Uh, you know, Economic activity is obviously way down, and jobless claims have been way up. I mean, there's been almost 10 million claims over the last couple of weeks. Right now, business owners are struggling to determine what their next steps are. And what we find interesting is sometimes in these crises, there are real consolidation opportunities. And companies that have a strong balance sheet are well positioned to really take advantage of this. Will, what are you seeing out there?
Yeah, I think the natural tendency for companies right now is to be defensive. That's certainly understandable, and depending on the state of your company and your industry, that may be the appropriate response. However, there are certain industries and certain companies that are able to be more offensive in this market and really could benefit from that, certainly today, but more importantly in the years to come.
Yeah, and developing an acquisition strategy can really help you position yourself to increase your market share, capture key accounts, add capabilities, product lines, or people, and accelerate your growth post-crisis. But the critical thing is you got to be able to move quickly in this environment, and because that ability will make you an acquirer of choice. So as we just said, now is the time to act. You'll need to move quickly. Business owners are anxious. They are looking for buyers who understand their business and who have the capital and the ability to move through due diligence process quickly.
That's right, Mike. And I think the other point is that it's not that you need to make the acquisition in the near term, although you may, but I think it's equally important to start the dialogue quickly because things are changing rapidly. And while a company may think they're positioned to make it through the next 30, 60 days, something can quickly change in the next week or two that might make that not possible for them anymore. And if you're already in dialogue with them, you can be in a position to take advantage of that.
Absolutely. So what are some of the key success factors when doing buy-side mergers and acquisitions? First one, create proprietary deal flow. So that could be, you leveraging your current contacts that you have and contacting businesses that similar to what Will was just mentioned, or developing that list of companies that you really like to get to know and starting to reach out to them now.
And I think an important point of that, Mike, is that don't assume that you know, even if you feel like you know a company well, don't assume that you know what's happening at that company because in this environment, they may easily have a key customer who's decided that they can't pay them right now or that they're stretching them on terms and it could cause distress. So I wouldn't cross anybody off the list at this stage.
Absolutely, or nor do you know the financial position of any company. I mean, their balance sheet could be upside down. They could be in a bad position for one reason or another. There are many issues in this environment that could put someone in a position where they're looking for an acquirer. The second key issue there would be is build a strong M&A team, and that would be internally and externally. Internally, you want to have the key people who can run the process and the people that you want to have buy-in throughout the process. But externally, you want to make sure you have the investment banker who can structure and negotiate the deal, a strong deal attorney who can write an agreement that will protect you, and an accounting firm that can look at the company's numbers and perform a quality of earnings and make sure that they're the company you're looking to acquire's performance is what they said it was. Next would be focus on core acquisitions, and that would be, who are the companies that are going to provide the capabilities that are going to really help your business grow. Right now is the time to really focus on your business and the type of acquisitions that will really enhance what you currently do. Pursue the right companies. Now that can mean a lot of different things, but in this environment, it's, what are strategically the right companies, the ones that you can get the right kind of deal with, companies that might appear healthy, but they're just having some issues at the moment, just the current crisis. But really, you want to find the right kinds of companies that are going to be a good fit, be a good fit culturally for you. Integrate relentlessly. This is very important. After you've made that acquisition, you want to make sure that before you've made the acquisition, you want to develop that strategy to integrate them into your business, and then integrate them in and make sure that you are capturing all those benefits that you identified during the negotiation process and during your due diligence process when you were identified this company you were looking to acquire them. Avoid deal heat. Even in environments like this, deals can get heating, can get emotional. What you don't want to do is let the deal heat lead you to make poor decisions for the company today, and more importantly down the road, when you and do a deal that is not necessarily a good fit for your company. There are always other companies out there. If this deal isn't going to be the right one, walk away. Right now, this is a very critical issue. Is structure the deal to limit your risk. You want to pay a fair price, but you can't necessarily pay the full price today in all circumstances. And you want to structure it so that there's a potential for the seller to get full value, but also to limit your risk. And we're going to go into this in more detail later on. And demonstrate the ability to move quickly. Business owners, sellers that are in this environment and see the need to sell, they want to save their employees, they want to save their business, and hopefully get some, get a fair price for their business. If you can show them that sellers that you can move quickly, they're going to appreciate that, and it's going to help move that deal process along a lot faster. So what is your M&A strategy? It's sort of critical. How do you go about this to be a successful acquirer? So really thinking this process through will help you be more successful. The first step would be research and develop criteria for the companies that you want to acquire. So what are the key attributes of the business that you're looking to acquire? This could be size, could be geography, capabilities, key accounts. There are a lot of different criteria that everybody could look at and say you need to determine which are the ones that are most critical for you. And then find the companies that you think are going to meet those criteria. The next step, create a target list. You want to develop that target list. You want to be as thorough as you possibly can be. A lot of times the only information you're going to have about a company is the little you might know and what you see on their website. But a lot of times, once you dig a little bit deeper, there's a lot more information there that that could make them a much more appealing acquisition candidate.
And Mike, do you have an average size of a target list for companies that we work with on acquisitions, or does it vary widely between our clients?
It can vary widely, but we usually advocate building target lists of anywhere between 30 and 50 companies. You want to be more targeted into the companies you approach, because these are going to be the companies that you're going to be most interested in acquiring. There are a lot of groups that will send out 1,000 letters and see what comes back. But what we have seen be most successful is developing a very targeted approach and finding the companies that really meet your criteria. You don't want to be too restrictive with that criteria so that you're eliminating potentially good acquisition targets, but you want to make sure it's you also don't want to be too broad so that you're going to be working through a lot of companies that are really just not a good fit. So 30 to 50 is where we usually advocate. Let's start with there in a particular criteria. And then we also advocate let's find, what's your first group you want to go after. Then maybe there's a second area you want to go after, and a third and fourth and fifth, so that you can really build up a pipeline of potential acquisition targets over time. The third step is align, with the specific business unit and its goals and objectives. This is critical for an acquisition to be successful. The business unit has to have buy-in. The business unit that's going to be overseeing the acquisition, they need to like the company, like the people, make sure that they bought into the goals and objectives, and really set the goals and objectives to make sure that after the deal is done, that they're going to work to get as much out of that company as they possibly can. The next, senior level involvement. This is critical. You want to keep the senior people involved, whether it's the board of directors, the C-suite. Keep them informed of what's going on, making sure they understand where we are in the process. If there are any issues that come up, you want to keep them educated as this process goes along, because what you don't want to do is get further along and then necessarily have surprises for them. So the transaction and due diligence process, we're going to go through the traditional process first, and then we're going to show you what we think a much more accelerated timeline would be. We've broken this down into 5 phases, and in the first phase, the call is exploratory due diligence, developing evaluation, and working toward the letter of intent. Traditionally, we think that's like a 30 to 60-day process. That gives you the time to speak to the company a few times, get that initial diligence list for them, allow us to build a valuation model and determine what we think they're worth, have discussions with that company about value. And we always encourage acquirers to have that conversation earlier on in the process. What you don't want to find is that you think they're worth X, they think they're worth 3X, and you're unlikely to find a valuation that's going to work for the two companies. We'd rather get to that point sooner and determine that there's either a fit or there's not a fit. And if there's not a fit, let's walk away friends and come back, and maybe we can explore this some point down the future. And in this point, normally you normally want to go visit the company, see their facilities, meet the people face to face, and that's obviously much more difficult to do today. The next few phases 2 through 4, normally take 45 to 90 days. This is after you've negotiated a letter of intent. You're going to go through a lot more of the transactional tasks and formal due diligence. This is where quality of earnings will take place. You do a much more in-depth business review. You're going to negotiate the purchase agreements, any sort of ancillary agreements that need to be put in place before the close, such as a lease or employment agreements, non-compete agreements. Then the next step would be to gain approval internally, sign the purchase agreements, work on the announcement, and then get the integration planning and work towards close. Typically, we see that take 45 to 90 days. Depends on the complexity of the company, depends on how quickly the parties can move through this process. And a lot of it will be dictated by the seller and how quickly they can gather the information you need to conduct due diligence. And then the 5th phase is integration, and that's post-close. Usually we see it takes about 90 days to complete. Now, in a much more accelerated process, as you see, we have changed the timeframes pretty significantly. The first 15 to 30 days for your exploratory due diligence, you'd want to end initial calls and work toward the letter of intent. This is where we really will show the seller that you can move quickly. So this and then this is really the importance of having that team that can help you work through the process. And then working through the due diligence, the agreements, we're cutting that down to 30 to 45 days. And the key thing there is, again, having the team and the buy-in from the people to help push this process along and to really work on this to make sure it gets done. This is where you make sure that you're structuring the deals to protect yourself, especially in these sort of accelerated due diligence processes. And then, since these companies are potentially struggling, you would want to look at shortening that integration timeline, maybe cut it in half to about 45 days. You don't want to rush it, but you also, if there's issues that are taking place at the company, you need to move quickly during the integration process to help the company and avoid those potential issues from getting bigger.
Mike, I think this highlights a couple points you made earlier, and then maybe one new point. The first is that working on a timeline like this makes it that much more important that your internal team, everybody from your management team that's going to actually work on the deal, to your board or senior management or shareholders that need to approve the deal, are aligned before you even go out to market. Because working on a schedule like this, you're not going to have time to get people up to speed. They're going to need to be on the same page from the beginning. And secondly, I would say that goes along with your capital sources. If you're not just funding this off the balance sheet with cash, you need to be sure that your bank or any other funding source is also aligned, because what used to be a pretty simple process of drawing on a line of credit may be more complicated these days as banks are becoming more sensitive as to how companies are borrowing money. So being sure all those things are aligned before you start the process is going to be key to working on a time frame like this.
Absolutely. If you think that you're going to need to use outside capital to complete an acquisition, you really want to make sure that's lined up. The lending environment is changing on a pretty almost daily basis, as our companies and their health, and you want to make sure that you have that lined up, and the bank is going to be willing to support you.
Yep, and I think same with the outside M&A team. I think we're going to talk about structuring here on the next slide, but the key is that your outside advisors, general counsel, investment bankers, accountants, if necessary, are ready to work on the deal that you want to work on, because it's important, even in an accelerated diligence process, to try to uncover as much risk as possible. Because what you want to do is buy a good company who's fallen on hard times, as opposed to just a bad company who can't survive a downturn like this. And this due diligence process is going to help you uncover that, and then also help you figure out how to structure the deal to protect yourself.
Absolutely, absolutely, and protection is critical, because what you can't do is make an acquisition that's going to potentially do a lot of harm to your company, either today or down the road. Before we get into structure, we're just going to cover valuation methods. There are three primary methods that we typically look at. First one being, comparable companies, so that'd be public market valuation. Try to see what those companies are trading for and how does that compare to the company you're looking to acquire. It just gives a good basis for a valuation. I mean, obviously there's some factors that are pretty different. Usually the public companies are significantly larger. They're obviously, stock is much more liquid, so we have to take those factors into account as well. The next method would be comparable transactions. So this is transaction specific. So we leverage our databases to look at similar transactions and what multiples that they trade for. Our primary one we look at is enterprise value compared to EBITDA, but we'll also look at enterprise value to revenue or other profitability measures, and try to get a good gauge of what other similar companies are trading for as well. The next method would be discount cash flow. We'd be looking at their projections and discounting that back to today using a discount rate that we develop based on that specific company. This one's a little bit harder to look at today, and all these valuation methodologies are a little bit harder because just valuations are very fluid at the moment, with with the markets up and down pretty significantly on a daily basis. And some of the transactions that took place 6, 12 months ago, are they really relevant to today? So you have to look at all of these three methods, and leave one more, with a very cautious eye. And this is where the structuring piece will come in. And then the last one we'll look at is LBO analysis. Is just how could you value them based on a leveraged buyout? So this is, with adding debt to the company, what would it look like? Is it increases the rate of return? It's not something. It's probably using all debt might not be the preferable method, but it's a valuation methodology that can be pretty helpful in determining the value of a company. So deal structure, this is very important in today's environment. It's difficult to pay the full value. As we discussed on the last slide, valuations are moving around, and as is the company's performance. So it's very difficult to determine what is a fair value for today. And also, you want to provide a fair value because you're going to need, most times, you're going to want that seller to be an important part of your company, and it's in integrating their company into yours. And you want to make sure they're treated fairly, so that they're going to be a good partner with you. So you said the first part is difficult to pay full value. So what do? You got to evaluate different structuring models that will be beneficial to, well, be fair to all parties. This will lead to potentially smaller upfront payments. And then you want to have contingent payments based on performance. Some of the items we've discussed is, do we want to just forget 2020 and look at your performance in 2021, and we pay you a multiple off that? It's looking at different options about how we can help bridge that gap in value, but be fair to all parties. And this is critical. You want that contingent payment to be simple and achievable. If you you overcomplicate what the earnout might be, or if it doesn't appear to be achievable, then you're really not giving the seller the value, and that can create issues for you if you need that owner to be part of your business and help integrate into that business and help you be a successful part of your larger company post acquisition. And yeah, as we just mentioned, it creates, this, in creating a simple and achievable, it creates credibility with the buyers. In addition to showing that you can move quickly, you want to show that you're a fair buyer, but you also got to manage risk, and which is critical.
Rick, it's interesting. I think we've changed so quickly from what really was a seller's market, not 30 days ago, to what has turned into probably a buyer's market here, particularly in some industries. Do you have a sense, if we were putting so much cash down for a buyer, they were giving 70 or 80% liquidity before, what do you think is going to take now to get a seller interested in doing a deal? How much cash do you think sellers are going to be looking for at closing compared to just a month or two ago?
Well, I think it depends on the situation. If the company's healthy and doing well, I wouldn't expect that to change too much. But if the company's in a little bit of distress, I would expect that a business owner would be probably somewhere in the 40 to maybe 30 to 50% range, and with the balance being paid in that contingent payment. So it has changed pretty dramatically, and it would really vary by the situation. And I would say even companies that are struggling more, the expectation might be even lower, because if you're a really distressed company, your value might not be much today, but there would be value, maybe in 6-12 months, once we've gotten to a healthier economy that can that your company would be better at thriving at. So the next topic is also on risk management, asset purchase versus stock purchases. You know, buyers, uh, they typically want to do an asset deal, and sellers, they're more interested in a stock purchase. You know, some of the key points with both on an asset deal, you know, it's generally favored by buyers. The reason for they get to step up in the basis of the assets and help minimize goodwill. It also limits the liabilities to those that are assumed in the purchase agreement. But if it's a C corp, the seller and the shareholders will most likely face double tax, which could consume a fairly large part of the purchase price. And you know, in C corps, it could be a real issue if trying to do an asset deal. In S corp, there is usually going to be a lower tax rate, but you will face the recapture tax on any step up in the basis of your assets. So for asset heavy companies, that could be a real issue. With a stock agreement, it's obviously favored by sellers. Buyers target is the liability is limited except is limited by the stock purchase agreement. If it's a C corp, there's no double tax on the gains, and so you'd be taxed at the capital gains rate. And if it's S corp, there's no recapture tax. The one exception there would be on a 338 election. That allows the buyer to mark up the assets and the deal gets taxed in a similar way to an asset deal. So it's a stock deal, but with the 338 election, you have the same tax issues that you do with an asset purchase.
Mike, it seems to me that in today's environment, we probably see a lot more asset purchases, particularly for companies that are truly distressed. If the buyer has an opportunity to renegotiate debt terms or potentially renegotiate with vendors, they may have the opportunity to structure it as an asset purchase so they can leave some of those liabilities behind as opposed to take them onto their own balance sheet.
Yeah, I would expect. I'm sorry. Go ahead, Will.
I was going to say, which is another advantage for buyers in a market like this.
Yeah, no question. And if your company is distressed, that the one that you're acquiring, you know, the gains might be pretty limited, so the tax issues probably become less. But that's very specific for each company and each situation. So I would think in this environment you're going to see a lot of buyers pushing towards the asset deal for those protections. I would agree. Some of the key transaction tasks, you know, pre-LOI, you know, the preliminary due diligence, you know, we want to do a fair amount of market and industry and competitive analysis. The service line compatibility extension, how does it compare to your company? How attractive are those customers? That's a critical one. And how does it fit in? You know, where is the overlap in your customers, if there is much? Operations facilities, you know, how do they run their operations and their compared to yours? You know, is there going to be upgrades that need to take place to get them up to your standards? Their systems and processes. You need to make sure you understand this. Then this is a critical piece of due diligence because you're going to get a better understanding of how their accounting systems and their numbers, and are there areas that you should be concerned about. And you want to also do a preliminary legal review, make sure that there aren't any big lawsuits or employment issues that could be a real showstopper later on, because you want to find out what the bigger items are before you spend a lot of money on outside advisors and a lot of your time digging into the company. And when there's an issue that you know you would either need to figure out how to get around it now, or you need to move on. And then critical, you know, what are the management team's goals? a lot of the deals that a lot of companies that are acquired, you're going to want that management team to stay on and be a part of your company post transaction. You need to understand that there's going to be the buy-in and that they're going to stay. Valuation, what was some of the critical items to look at? What are historical financial performance, their growth rates, margins? Do they have recurring revenue? How clean are the financials? Are there a lot of what we call add backs in there or other issues that need to be evaluated and validated? What's their projected financial performance? That takes on initial importance today. Reviewing those projections, making sure that they're believable, that they're achievable. Customer concentrations, we typically view that as any customer that is over 10%, you want to be a little bit more concerned about, and because losing that customer would be pretty critical to that company's ongoing health. You want to make sure that company, the relationship is good. You probably want to try to speak to that customer before you close and make sure that they're going to be there. If they're under 10%, those issues become less important. If there are vendor concentrations, do they have a dependency on any one vendor, similar to provide them the goods that they need to operate. Similar to customer concentrations, you want to make sure that those are limited. Are there alternative vendors that can supply the same materials to continue operations? It's all about managing risk. And then capital expenditures. What does the company need to expend annually to grow, to maintain their current operations? If there's a significant amount of CapEx that needs to be invested, it might impact the value. And you want to understand what those CapEx needs are going to be, especially over the next few years. Some other key tasks, the way we look at deal structure, you're going to do the purchase price, identifying financing sources if needed, structuring and negotiation of key terms, due diligence. You want to set up management meetings. There might be multiple meetings that are going to take place with different group parts of your management team, meeting with different parts of their management team, and really learning the business and making sure that your assumptions about the company are correct. Build a data room. We use an electronic data room, as is pretty much every investment banker today. It really helps with the dissemination of the information to all the relevant parties, including your outside advisors. Manage the due diligence process. You want to try to make this as easy as possible for the seller. You're going to ask a lot of questions, and rightfully so, and you're going to ask for a lot of materials, but you want to try to limit any duplicate requests and making sure that all the people can review the materials that need to have access to them. You want to continue, as you go through the deal process, you want to continue to monitor the valuation. You're going to look at the trailing 12 months, keep updating that over as each month ends. You want to keep updating the trailing 12-month analysis to make sure that the performance is maintaining level or hopefully improving. And if it's going down, you need to understand why. You need to understand, evaluate synergies. What are those potential cost savings that are there? How they help the company? How quickly can you achieve them? And what is it going to cost to integrate them into your operations? There are always going to be costs in terms of people, expansion of their, simple things like expanding their IT to integrate them. There are going to be a lot of costs around integrating into your operations. You need to make sure you understand what they are. And then, as we talked about before, transaction structuring, stock purchase, asset purchase, 338H10 election. These are all critical tasks that you need to go through. So post LOI, you want to build the data room. You want to do the facility tours, operational reviews, go dig into the human resource, their human resource policies, make sure there are any issues, look at their pay practices, and their company that there might be environmental issues. You want to make sure that you do a phase one so that you understand if there are going to be any potential issues, and if so, dig into them deeper. Transaction documents, you want to negotiate the purchase agreement, escrow agreement, any employment agreements. Once the agreement negotiation, you're gonna want to get a board of approval from the board of directors. Sign off on the deal. This is where we talked about keeping them updated on the process. That's usually going to make the approval process much simpler. Once you've gone through the approval process, you sign the purchase agreement, make the announcement, and then the integration and organizational integration planning. You want to get that moving as quickly as you can. And then you close, which is usually the most anticlimactic part of the transaction. So what are the key formal due diligence areas? And we see we've broken down into what we view as the key areas. First one being legal. You want to make sure that all corporate documents are reviewed, contracts are reviewed, any legal proceedings, compliance issues, environmental information. Then the next one would be financial. You want to assess all financial statements and reports, forecasts, accounting paperwork, AR, AP practices, inventory, plant, property, equipment, rebate information, conduct that quality of earnings review. Human resources, this is a critical one. You want to make sure that you understand the organizational charts, the personnel files, with their employee handbook, their policies, turnover. If they had a lot of turnover, that's usually a sign that there could be some issues with the company. How do their compensation plans compare to yours? Benefit plans, employment agreements, do they have any? And with the benefits, what we see a lot of times, the acquirer can have a more generous plan than the seller. What are those additional costs? You need to understand that. Operations, you want to review and assess the management reports and operating metrics, order flows, purchasing. You want to make sure you understand how their operations work, how they're getting shipments out, how they're bringing the product in. You want to understand from when the order is taken till the time it's shipped and the money is collected, and you want to go through that process in detail and make sure you understand that how the company operates and how does it compare to what you do, and changes that might need to take place to get them up to your standards. Sales, you want to understand their sales methodologies, their territories, commissions. If they have territories, you want to understand what their restrictions are, the pricing, how have they grown? Is it through expansion of new sales, increases in prices, lowering prices to achieve additional volume? You want to understand all those, what's been going on in the sales process. Information technology, you understand their hardware, their software, how does it integrate into their people? How do you integrate this into your IT infrastructure? A lot of times you find people using different software programs and sorry about that. And that can make for potential, not potential issues, but you want to make sure you understand it and how you can integrate it and what issues that are going to need to be addressed. Taxes, you want to make sure you understand that they've been paying all their taxes, whether it's federal, state, local. A lot of what we're seeing, a lot of states being more aggressive about trying to collect taxes. So you want to make sure that they are any states where they might be operating, or if any state that they might have nexus, that they're filing and they're paying their taxes. And if they're not, you need to understand what the exposure is and make sure you're protecting yourself. Safety, depending on what industry you're in, this certainly takes on more of an issue, can become more or less of an issue. But obviously, the safety and of the employees is critical. You want to understand incident rates, what's been are they going up? Are they going down? And if they are, what is causing them to move in that direction? What is the safety in the training materials they have? What ongoing safety training do they do? And then this really leads into the last item, is insurance. the safer the company is, the lower the insurance rates will be, and you want to go through the understand their insurance, what their policies and the protection they have in place for the company. So at this point, I'm going to turn it over to my colleague Will, who's going to talk about some of the issues with ESOPs and acquisitions.
Thanks, Mike. So we counsel a number of ESOP-owned companies on making acquisitions. Primarily, they're buying non-ESOP-owned companies, and I think all of the things that we've addressed to date apply to those acquirers that are ESOP-owned, but some additional wrinkles certainly apply when you're an ESOP company, which can impact both the sellers that are selling to the ESOP as well as the ESOP company itself. So I think from the seller perspective, you may have a company that's more willing to buy stock as opposed to a non-ESOP company. That's primarily because an ESOP operates on a tax advantaged or tax exempt basis. And if the ESOP owned company isn't paying any taxes, then the ability to mark up assets and take deductions is less important to them. However, in today's environment, the ESOP company is also very interested in protecting themselves from liabilities. So you may see a stock deal, but it might have some more protections in it for the buyer than you may normally see in a stock purchase agreement. And then the seller, the ESOP company, may be able to offer 1042 to the target company. 1042 is the ability for the seller to defer all of their capital gains in a sale. Depending on the value of the company today, the seller may have a significant capital gain built up in the deal, and the ESOP company may be able to help the seller avoid that altogether. For the ESOP company itself, it operates on a tax advantage basis, and the acquisition may help them generate some additional tax deductions. If the buyer uses the ESOP directly in the transaction, then effectively it can deduct the purchase price over time and help them save taxes over a long term. And then in a situation where the ESOP is already 100% owned by the ESOP, that company pays no federal income taxes, and the companies that buys will also pay no federal income taxes. In an environment like today, while the target itself may not be paying income taxes if it's losing money, certainly in the future, when it does become profitable again, the ability for the buyer to harvest all of that income as opposed to paying taxes on it helps minimize some of the risk, because you're able to harvest and keep more of that cash that company generates in the future. The other advantage I would say that ESOPs have in a deal like this is in a seller who's in a distressed situation. Oftentimes, one of their biggest concerns is what's going to happen to their people and how their company is going to change in a potential acquisition. ESOPs are often very employee-forward companies, and it may help the seller mentally to feel like they're selling their company to an ESOP in which their employees are going to benefit. So as opposed to selling to one individual buyer who's going to take advantage of the future growth of their company, ESOPs spread that wealth amongst all the employees, which will include the employees of the target company. And that can be sort of a mental hurdle for a seller to get over. If you are an ESOP, or you're maybe selling to an ESOP, or you're on a board or work at an ESOP, I think there's some ESOP specific issues that you want to be thinking about when you make a deal like this. One is, how is your stock value going to be affected? I think if you've been an ESOP for any length of time, your ESOP participants and employees are likely very focused on your stock price, and how that's affected in an environment like this by making a deal can impact the employees. Certainly their ideas of how the company is surviving in a time like this, or if they know about the acquisition or are involved in it, their opinions about the acquisition can certainly be impacted by how the stock price reacts to it. On the other hand, it could be a good cover to do a deal in a time like this when participants may expect stock price to be volatile. Could be a good time to do a transaction and have that be caught up in the noise, if you will, or help buoy the stock price if you feel like yours may go down in an environment like this. you have a choice to make whether you have the ESOP by the company, ESOP by the target, or the company. Often the company is going to make that acquisition. I think in most of the cases, we see the company make the acquisition. But if you use the ESOP or if you don't, a lot of questions to answer. Primarily, I think one that goes to a point that we've made in the past is, are you going to need opinions? Is the ESOP trustee going to need a fairness opinion? Is the board going to need one? All those questions need to be answered early so that you can have your team prepared to make the acquisition. And then an important one is, I think, should be paramount in all decision making that ESOP companies make is what's the effect on participants? And if I'm a board member, how is this acquisition going to impact those participants? And what should my analysis of this be? ERISA rules are different than the business judgment rule. Business judgment is a board level judgment test, meaning the board is making the decision based on their best judgment. Fiduciaries are held to a higher standard under ERISA. Are they evaluating this acquisition for the exclusive benefit of the current ESOP participants? So understanding the difference in those and knowing, particularly as a board member, what you should be using as your basis for evaluating the target are important. Some technical ESOP questions which need to be answered and studied and in this compressed time frame can be challenging, but certainly something that we work with ESOP companies on is, when am I going to incorporate the target employees into my ESOP? And also, how's that going to impact my repurchase obligation? What if I've allocated all of my shares already? How does that impact new participants? How are they going to benefit from the ESOP? And then, one more interesting question, which requires different analysis on a target by target basis, is what if this is going to make my company more valuable, but this target that I'm acquiring has many more employees than I do? So the new target employees are really going to benefit most from my future stock growth. Is that something that I need to be concerned about? Or is that something that is okay because my current ESOP participants are going to benefit from that as well? So a few more questions to answer if you're an ESOP to continue to make acquisitions, something that we're very familiar with and advise companies with on a regular basis, and something that can still be done on an expedited time frame for ESOP-owned companies that very likely can be seen as a buyer of choice in an environment like this. We've hit the integration drum quite a few times, but I think it's even more important from an ESOP perspective, because the employees you have now that are in your ESOP are likely much more attuned to the culture and how a potential acquisition may impact that culture, as well as their benefit through the ESOP. So important to determine when you want to include the target employees and how they're going to fold into the ESOP. Are they going to be included right away? More likely, they're going to be subject to the waiting periods and vesting periods that you have in your plan, but something you want to be thoughtful of as you move forward. And then also, how you include them in your ESOP will directly impact any changes in repurchase liability. Repurchase liability meaning how you buy shares back from ESOP participants, which of course is a claim on cash, which is vital in this environment to maintain as much cash as you can, and making sure you understand how that repurchase liability might change is going to be very important prior to making an acquisition in today's environment.
So, we've gone through sort of the process and how it can impact your company and how to go about this, and how are we able to help you? We have been very successful with helping companies to make develop a strategy and execute on these types of acquisitions. We've developed a standardized process and procedures, battlefield tested strategy and approach, and really institutional knowledge surrounding valuation, due diligence, terms, and structure. It's been critical, been a big part of why we've been successful. We're strong at helping identify those criteria and the targets, and then approaching the targets. We want to confidentially protected during the process. We want to take a lot of the upfront work off your hands so that we can go out there and find these targets for you, and then and allow you to focus on your business and operating your business, which is even more important in today's environment. And why hire an investment banker? PC provides transactional leadership while you focus on your business. We're going to do a lot of thorough market research. We do professional searches that are going to minimize management resources. We've developed a process that's going to make this simpler for you. And then we're going to connect you with multiple targets. We've been very good at helping to develop a real pipeline of acquisition targets, especially for companies that want to work on this over many years. We're going to find you the right sellers that are going to help you enter new markets, expand your capabilities, and most importantly, increase value. And it's a very strategic process. We're going to have, the way we work, the goal is to minimize your price, but be fair and give you the best transaction structure, and try to find those opportunities that are going to be less competitive, that are going to allow you to pay a lower price and get a good structure. One of the real benefits is bypassing the auction. A lot of companies that make acquisitions, a lot of times they find companies that are brought to them. But if you have, if you can develop proprietary deal flow, if you have industry connections, a dedicated team, creative strategies, good market data, it's going to allow you to pay less. And that's obviously, the goal is to be fair, but you want to pay a price that, you don't want to pay any more than you have to when making an acquisition. Our process, it's efficient. We create a lot of value through our buy-side process and our experience, our negotiating experience. We work on sell-side mandates and buy-side mandates, and a lot of what we do is helping to develop negotiating strategies that's going to help our client achieve the most optimal outcome. And then efficient analysis. We're going to perform in-depth evaluation on each target quickly and efficiently to help you better understand the values of companies. We're going to work the ability to cost savings recognition so that you can determine what benefits you can get out of the company post close, what savings you can get, and also what costs that are going to be added. Transactional knowledge. We understand how sellers think, and we can know how to best counter them for you when you're trying to make an acquisition. And then due diligence expertise, and this is critical. Analyzing companies and identifying issues that could potentially enhance or reduce value. In this environment, you really want to be focused on due diligence and making sure you understand what those issues are, because you want to understand what is going to add value to your company, but also, just as importantly, what is going to reduce value for that company and could potentially be harmful, and getting out in front of them. Here's just some data on the multiples that companies sell for, if they're represented versus non-represented. As you see, a real advantage for companies if you want to go on a buy side through a buy side process. Finding those targets that are not represented and developing that pipeline, it can be a real savings in terms of value. And then, it's almost 80% of sellers are not represented by an investment banker. So this you see the advantage of going out there. A lot of these deals that are getting done that today in this market, or in the market, and just historically, they're not working with investment bankers. So there's real opportunity to develop that pipeline, because a lot of sellers sometimes are not thinking about selling until you approach them, and then they start to think about what that would mean to them, and they see a good buyer, you show them a fair valuation, and they're interested and they want to move forward. How do we help you? As we talked about before, our experience, industry knowledge, connections to the right partners, understanding the objectives of buyers and sellers, understanding the marketplace, developing long-term relationships with you and with the target list, the prospective acquisition targets, and then, catering to your objectives. It's really making sure that we find the right targets that you're looking for that are going to be most advantageous for you. And then where do we spend all of our time? It's in the middle market. So we understand the companies that are here, and we understand a lot of the potential idiosyncrasies that take place in this market and have a thorough understanding. Here's just some of the transactions that we worked on the buy side. You see these across a number of industries, and you see a number of names have popped up on multiple times. We develop long-term relationships. Our goal is to be a strategic partner to you to help develop a acquisition process, and then let's go out and let's not just do one, but let's go find multiple acquisitions that are going to add value over time. And since this is recorded, if you do have any questions, we encourage you to contact either me or contact Will. You can email us, or you can call us on the direct number above, and you will see it'll be directed right to us, to our mobile phones, and we're happy to answer any questions you might have. So please feel free to contact us. So key takeaways, we're hoping you got from this presentation: current market and the stress on some companies. It is a pretty unique time to develop and execute an acquisition strategy. We think there could be real value to be gained right now. You got to be able to act fast. We've said this multiple times throughout the presentation. The ability to move quickly in this environment is really valuable. Just as valuable just as important is you got to be able to manage your risk with deal structure. You got to find a structure that's going to work for both parties, and that limits your risk today, but provides value to the owner down the road. And in this environment, be prepared a significant amount of time negotiating or renegotiating lease or potentially debt held by the target. Companies in stress, you're going to have to find situations to change their P&L and make them more profitable, and sometimes that could be renegotiating leases. And with debt, if the company is not worth what the debt is, you're going to have to speak to the bank and see what flexibility they have. And then post-transaction integration is more important than usual. Now you need to really be focused on having that plan and integrating that company into your business in a thoughtful but in meaningful way, but doing it quickly. So, Will, any final thoughts before we sign off here?
No, thanks for leading the slides, Mike, and I thought went well.
Well, we appreciate everybody who's listened in, and as you said, please feel free to contact one of us if you have any questions. And Will, enjoy doing this with you. Appreciate you taking part.
Likewise. Take care.
Bye.